Welcome to Business Innovators Radio, featuring industry influencers and trendsetters sharing proven strategies to help you build a better life right now.
Welcome to the show. Today I have a guest who has vital tax information that will be of particular interest to our Canadian listeners. My guest today is Arden Vanderhorst, and Arden is a chartered accountant from Whitby, Ontario. Some of the services Arden offers his clients include personal and estate and trust taxation services, along with small business services and financial statement services for businesses and not-for-profits. As you are aware, there has been a regime change in Ottawa. Canada's new Prime Minister is Justin Trudeau, and while on the election campaign trail, Trudeau promised to change many taxes that will affect most every Canadian. So at this point, I'd like to welcome Arden to the show. Hi, Arden. How are you today?
I'm good, thanks, Tom. Thank you.
Great. So good. We have a lot of questions from, in the minds of Canadians everywhere regarding the tax changes. So I'd just like to start by asking, a lot has been mentioned about Trudeau decreasing taxes for the middle class and increasing them for others. Can you share the details of that with us?
Well, yeah, the plan that was touted during the campaign is that there would be tax breaks for the middle class, and then accompanying increases that were sort of meant to offset those breaks as increases to higher levels of income. As well, changes to the child benefit programs that were offered, as well as obviously tax-free savings accounts. Just a week or so ago, on December the 7th, the Liberals have confirmed that effective January the 1st, 2016, the second lowest rate or bracket, basically that covers income between $44,700 and $89,401. The marginal rate for those the rates of tax for that bracket will decrease from 22% to 20.5%. And so according to those numbers, that's about a savings of about $670 per year, or as much as $1,300 for a two-income household for individuals that fall within that bracket. In tandem with this, for those individuals who earn over $200,000, the tax rates will change from 29% to 33%. So this will cause a person earning $300,000 to pay approximately $3,300 more in tax, whereas someone earning $400,000 will pay about $7,333 more in tax. And some of the more startling, I guess, in terms of percentages, is that in Ontario, the marginal tax rate for ordinary income is going to be 53.53%. So that's quite staggering.
That is quite startling to me too. So, and what did they change in regards to charitable donations?
Well, what they changed in terms of the charitable donations is currently an individual who donates over $200 will get a tax credit of 29%. The Liberals announced on December the 7th that they will allow a new tax credit of 33% for gifts over $200 to the extent that the individual has income that is subject to this new 33% tax rate.
Right. And what other changes can Canadian families expect specifically?
Well, in 2015, the Conservatives introduced what was called the family income tax cut that allowed the higher earning spouse in a family with kids under 18 to notionally transfer up to $50,000 of income to the lower earning spouse, so it could be taxed at a lower rate. The maximum tax break under this measure was $2,000. The Liberals have confirmed on December the 7th that they will introduce legislation in 2016 to eliminate this. But sort of as a side note, I guess, in this past tax season that we did, we saw very few families max out this benefit, and actually found a lot of people were disappointed that they didn't qualify for it. So I'm not sure what the impact to an average family will be. Also, that what came in on December the 7th was legislation, sort of a notice, I guess, that legislation will follow shortly to replace the current UCCB, which is the Universal Child Care Benefit. That's the sort of the $160 or $100 a month that individuals receive. they're going to replace that with a program that, according to them, a family of four with a $90,000 income will receive roughly $2,500 a year more than what the conservative plan they would under the conservative plan. And then families with household income over $200,000 will not receive anything under that plan. There aren't any further details available, though, but we do know that the Liberals are looking to replace the universal child care benefit, the child tax benefit, and the national child benefit supplement with a new Canada Child benefit that is income tested and will actually be tax free. But like I said before, we haven't seen any details about that. For families that have children in post-secondary institutions, the Liberals actually have come out and said that they are looking to eliminate the education and textbook tax credits, which are worth about $60 and $10 respectively. So there are changes on the horizon. They are coming, and they actually will impact families.
Right. Yeah, I can see that. So as a follow-up question, if this actually happens, what do you suggest middle-class families do with the extra money for the proposed cuts? Save, invest? If so, how should they save, or what should they invest in?
Good question. I would say that it's easy to save and invest the money received from the current universal child care benefit, because it comes in, you can have it direct deposited into a special bank account that's separate from sort of like your checking account. Hopefully the new child tax benefit will follow similar rules, and that will help families save it. But as for savings on the tax cut itself, of course, I think it's better to invest it, but this requires discipline to take that tax refund and set it aside instead of seeing it as a windfall and putting it sort of into the general checking or spending it on something. As in terms of what to invest in, I mean, that is obviously a question that's best left to an investment professional. But I would recommend people consider RESPs for their children, because the government does provide contribution towards it as well. And I think that is something that a lot of people either aren't taking advantage of or aren't aware of.
Right. So what segment of the Canadian population will pay higher taxes under the Trudeau government? Is there anything that they can do to lessen the proposed tax burden?
Well, for individuals that are earning salary income, there are some strategies available. Like one thing that people should consider, like if they are going to be affected by the increased tax bracket over the $200,000 mark, they should consider making RSP contributions in 2015, or if they have undeducted contributions from prior years, they may want to consider carrying them forward, provided they have sufficient room to 2016 or future years, because they're going to get an increased, more bang for the buck, more refund for what their RSP deduction. For individuals with corporations, we're looking at the cost benefit of accelerating salary payments in 2015 and taking lower amounts in further years. I mean, there are different considerations that need to be made, but one needs to be careful, sort of not to shoot yourself in the foot, trying to shoot yourself in the right foot, trying to save the left foot. So it does require some planning and some thought.
Right. And what about investors?
The biggest change for investors will be that on December the 7th, Liberals have confirmed that TFSA contribution limits will in fact fall back down to $5,500 for 2016 and later years. This is unfortunate. But again, I mean, you need to keep in mind there's still a lot of people out there who haven't looked at TFSAs or opened TFSA accounts. And for instance, if someone has not contributed to a TFSA account yet, as of January the 1st, 2016, they'll have a cumulative contribution room of $46,500, which would be a significant investment for them.
Right, absolutely, it sure would. So what will happen to claimings like employment and expenses?
Well, there are no specific changes to individuals claiming employment expenses, such as salaried individuals or commissioned salespeople. The big change that I'm seeing in my practice and hearing about is increased audit activity by the Canada Revenue Agency. They're realizing that a lot of individuals claiming these expenses don't have the required forms to claim the expenses that they're claiming, or they don't have the documentation to substantiate their claims. We're very vigilant with our clients and that they have the T2200, it's called, the Declaration of Employment Expenses. But we are telling clients to make extra sure that they have documentation for what they are claiming as expenses. And most importantly, they are maintaining proper logbooks for automobile travel, for claiming that, because the CRA knows that this is a weakness. They know that it's something difficult to do, and they're focusing on this as a source of increased tax revenue.
Right. Okay. Very interesting. So what will happen to small businesses with employees? Are there any changes to payroll taxes businesses need to be aware of?
Well, the good news is that on December the 7th, the Liberals did confirm that they will reduce EI premiums. However, it's not going to happen until 2017. The other bad news is that it's actually going to be the reduction will be less than the Conservatives would have raised it. However, it will reduce the expenses that employers incur on payroll taxes. I would say the worst news out of all of it is that the Liberals are committed or have indicated to raising CPP benefits, which means that CPP contributions will increase and will thus create more of a burden on employers. The only silver lining, I think, to this might be is that Premier Wynne has made comments that if CPP is increased, she may reduce or eliminate the Ontario Retirement Pension Plan that is slated to come into effect in 2017.
Okay. And what about corporate taxes? Is there anything new there businesses should be aware of?
Well, the Liberals have said they have committed to lowering the small business tax rate that small corporations are subject to on the first $500,000 of income. They have said that they will reduce it from 11 to 9%. This is going to be over 4 years, starting in 2016. There's been no real details on when it's coming. Business owners feel that, if they feel they can benefit from this, they can use legitimate ways to defer income from 2015 to 2016 or beyond. So it does present an opportunity there. Some of these strategies overlap with some of the issues mentioned before with respect to the higher tax rate for high income earners. The Liberals have also stated they want to ensure that corporations are not used to reduce personal income tax for high income earners. No real details about this, but it is somewhat some disturbing overtones.
Right. Oh, clearly. Are there any other things you are seeing relevant to owners of corporations? Right.
Well, in my practice, I meet lots of individuals who, in order to get a contract or a position, they're forced to go incorporate a company. Essentially, this corporation only has one client, and if it weren't for the corporation, they would essentially be an employee. These are called by the CRA. These are called personal services businesses or PSBs. In 2011, the CRA stripped these corporations of the benefits that other small businesses have, such that PSBs are subject to the highest rate of tax, and the only expense really that they can have or essentially entitled to is the salary that's paid to the owner-manager. Not surprising that many people don't like this and don't like the rules that have been inflicted on PSBs. But it is somewhat surprising to me how many individuals are not informed about this by their tax preparers. And the danger now is that we are beginning to see increased audit activity as the CRA sees this area as rampant with non-compliance. So I guess I would say to the listeners, if you think your corporation may be a PSB, it's recommended you have a discussion with a tax professional as to the factors that the CRA looks at, as well as the tax implications that could occur.
Right. Yeah. Sounds like a lot of implications there, actually. So what about owners with several closely held corporations? Well,
in 2015, the CRA quietly released new rules that may impact the way corporations pay dividends to holding companies after sort of with an effective date of April the 20th, 2015. The CRA hasn't really provided clarity on these new rules. But for corporate groups in my practice, we're sort of making sure that they're on side with the strict interpretation of the rules for the most part. And we're trying to hold off paying intracorporate dividend payments until the CRA provides some clarification on their position on these rules.
Have the new personal tax rates for 2016 affected corporations in any way?
Yes. On December 7th, in concert with the increase in personal tax rates, the government is making it less beneficial, read in there, more expensive, to earn investment income in a private corporation. I still believe, though, that there are opportunities for a business owner to sort of build a retirement nest egg inside a corporate structure that is better than an RSP, but it is not as beneficial as it was on, I guess, on December the 6th.
Right. So what do you see happening next for owners of corporations? What should they know? Well,
one of the biggest areas of concern on my mind is comments that the Prime Minister made during the election, making it clear he's not fond of individuals using their corporations to avoid tax within the confines of the rules, obviously. There are no concrete details out there, but doctors and lawyers and possibly other incorporated professionals should be aware that they may be in the government's sights for tax changes. There are also rumors that the government may adopt something similar to what Quebec is phasing in 2017. What they are doing is saying that in order to access that preferential rate of tax for small businesses, that the corporation must have more than 3 full-time employees. And that's quite scary when you think, of all the small businesses out there that run our economy and represent economic growth and innovation. I mean, I'm not trying to be political, but I'm just saying it is scary thinking that, small business drives our economy. And at what point does a small business owner sort of throw up their arms and say, why should I hire more people if I'm going to lose the 53.53% of my additional profit to taxes?
Oh, absolutely. And what about estates and taxes? Is there anything we should be aware of? The following questions deal with personal tax issues, not business-related tax issues per se.
There are many changes actually that are coming into effect for the taxation of trusts on December 31st, 2015. Too extensive to sort of cover in a few minutes, but the basic change is that starting in 2016, an estate will only be allowed to benefit from the graduated rates of tax. So currently an estate that is formed when an individual passes away doesn't start at the high tax rate. It kind of gradually has the graduated rates of tax like an individual. But what the government has now said is that starting in January 2016, the estate will only be allowed to benefit from these graduated rates for the first 36 months after an individual's death. After this 36-month period, the trust will be subject to tax at the highest marginal rates, that 53.53%, from the first dollar after that. So previously, as I mentioned, these graduated rates were available indefinitely and have been utilized by many trust arrangements to reduce the tax burden. There is no exemption for previous created trusts. So if you're an executor of a trust, you should consult your tax professional for more details about these changes and how it's going to affect the trust that you're running.
Okay, well, great. That's quite a lot of information for all of us to digest, Arden. Thank you very much. I'd like to thank you for coming on the show. Thanks very much, Arden. So that was Arden Vanderhorst. I'm Tom Holub, and we'll talk to you later. Thank you very much.
Thanks for listening to Business Innovators Radio. To hear all episodes featuring leading industry influencers and trendsetters, visit us online at businessinnovatorsradio.com today.